Hello everyone. SCD Asset Management presents Net Zero Emission Impact Investment Proposal. We will present a report on how we are reaching our goals, our latest milestones, and what's coming up next. Our proposal agenda will take you through the overview, climate change, net zero targets, proposed portfolio, and solution framework, and finally, the roadmap. Meet Green Dreamers, the asset managers of SCD. The team includes Kumar, me Payal, Christina, Stella, and Francis. The following are the goals of our case. We need to invest $1 billion in endowment fund with an objective of low fee and risk tolerance and provides reliable fixed income with moderate long-term growth. We are targeting North American, European, and Asia Pacific markets, and we will invest in medium to large cap equities and AAA to BBB plus rating bonds. The investment goal over a 10-year period is 4.5% in addition to the average CPI of 5.1%. We aim to invest in top green equities and fixed income securities. Now, why should we care about climate change? Physical risks such as temperature rise and more frequent natural hazards will continue to build up until the net zero is achieved. A universal transformation of decarbonization is demanded. Now look at this grid from World Economic Forum. The current trajectory is not looking positive if emissions grow at the same rate. Therefore, emissions of carbon forces are to be reduced by more than 50% in pathways to limit global warming to 1.5 degrees. Commitments made by governments so far are far from sufficient. Reaching net zero emissions will require a transformation of the global economy. Now, the table shows the overall ranking and indicates how the countries perform in the 4 index categories, that is the greenhouse gas emissions, renewable energy, energy use, and climate policy. 40% weightage was given to GHG emissions and 20% to the remaining 3 categories. None of the countries achieved positions from 1 to 3. This is so because no country is doing enough to prevent dangerous climate change. Many of the leading countries have enshrined their policies in law or formed cross-party coalitions to tackle the issues and set plans in motion. 67 countries assessed have a carbon neutrality ambition. 16 have translated that into a sector roadmap with targets, while just 8 have strong targets supported by an efficient policy framework. To transition to a low carbon economy, we recommend all active participants to reduce absolute GHG emissions, to make government policies change for better structuring in carbon pricing, building standards and fuel efficiency, to adapt low carbon technologies like renewable electricity, electricity vehicles, mass transit, and by encouraging consumers to make green purchase decisions such as buying locally. Now Kumar will discuss about the carbon offsets.
Thank you, Payal. We will now discuss carbon offsets as they are a hot topic when we hear of companies setting net zero targets. There are many issues globally with the carbon offsets. One is the issues of permanence. Sequestration projects need to ensure that emissions are kept out of the atmosphere for a reasonable length of time. For example, carbon is drawn into and locked within a tree only if the tree is green and growing. Once it starts to decay, its carbon goes back into the atmosphere. Double counting occurs when 2 entities claim credit for the same climate action. An example is a company funding a project in one country and the host country of the project claims the credit as well. Lastly, what we mean by legitimacy in the global south is the lack of regulation in developing countries when we look at these projects. There can be very little transparency in these regions. As your portfolio manager, we will ensure that any carbon offset that we will do will only go towards high valued projects in developed countries to minimize these issues faced. One such project that we have discovered is the project in Germany. This Moorland project costs €64 per ton of CO2 released. The new wetlands help capture CO2 and create habitat for endangered species. These wetlands has recorded CO2 reductions to 790 tons annually. We have verified the impact of this project and will continue to look for many others if they are needed to offset our portfolio for carbon emissions. As we saw in the last slide, the cost of such projects can be considered more on the higher end. As demand is growing for carbon offsets, the price today are estimated at $3 to $5 per ton. By 2030, we can expect the prices to tenfold to average out around $20 to $50 per ton of CO2. In terms of the value proposition of creating the low emissions environment, according to a report by McKinsey, net zero transition could result in operating savings in the long run as demand will decrease for high emission products and increase in uptake of low emission product will create growth opportunities. As an affluence investor, we want to create impactful environmental and economic values. We can improve the liquidity and lower the cost of capital for green activities and provide ESG positive portfolios which are less exposed to physical risk, such as acute natural disasters like drought and floods. Now, Christina will take us forward.
Now, let's talk about the GHD protocol and our emissions targets. Our ambition is to reduce Scope 1 and 2 emissions to 1.5 degree net zero by 2032. Our interim target at 2025 is a reduction of approximately 30% relative to the 2022 baseline. Sector-wise, we aligned the chosen 4 sectors top to bottom according to their overall emissions intensity. We also added an inventory and projected-based accounting method for the reduction calculation. This addresses the reductions from the upstream suppliers and downstream consumers level, which are related to the Scope 3 factors. Now we talk about our financial targets. Over the next 10 years, our projected return is 9.6%, which includes the estimated inflation rate of 1.64%. We will support the growth of investments into renewable energy, green buildings, sustainable forestry, and agriculture. In addition, we continue to report on progress on climate positive investments. Our engagement target involves active stewardship to engage issuers, regulators with the investors. We will be focusing on the highest emitters. Firstly, we state our purpose. Secondly, the decision-making will engage through public activism, proxy voting, and private meetings. Then for empowerment, we influence companies to engage and exhibit their governance policies. And finally, to monitor the performance, we will execute the divestment practice through negative screenings based on their emission pathways and societal values. Here, our team will actively manage the fund with a top-down approach. Our objective is to track the investment results from an index composed of large and mid-cap developed market equities and fixed income securities. As clients prefer, the solution will be environmentally responsible and lower in fee. Management fee is 0.2%. Furthermore, the portfolio will align with the EU Paris-aligned benchmark and the climate transition benchmark. We target the North America and the developed markets in Europe and Asia Pacific region. Our focus list for sectors are based on lower emissions level, which are in financial, consumer staples, IT, and healthcare.
Thank you, Christina. Next, let us move on how we are going to select the portfolio. Here, we can see that we are applying several Sustainalytics database to a 4-factor ranking. First, we are applying GIC classification and EU taxonomy standard to identify sectors which has lower GHG emission in Scope 1 and 2. And then we will apply SASB standard to select eligible ETF, stocks, and bonds that have lower GHG emission. SCD will diversify the selected eligible product into appropriate portion for the portfolio to derive the most efficient portfolio and meet clients' desired revenues. From this graph, we can see the proportion of Scope 1 to 3 emission coming from this sector. This helps us to determine the sector where emission will likely to be the lowest for when we choose investment for your portfolio. Another metric that we would use comes from the MSCI. When creating this portfolio, we use this metric as it was readily available on RBC Global Asset Management. It measures the carbon intensity of each fund that we look at. By looking at the funds, we find the lowest carbon intensity. We can have a portfolio with the lowest emission possible. The downside of this metric is the Scope 3 emission are missing. We will address this in detail in the later part and along with our calculations. We also refer to Sustainalytics and additional company screening metric. We purchase data from S&P Global and Sustainalytics to achieve green optimization. Selecting company will be mainly based on carbon intensity and carbon solutions. Carbon emission are attribute based on the equity or debt ownership related to the enterprise value. This carbon intensity represents the emission value in relation to a specific financial metric. As revenue is closely linked to the productivity, it is a good indicator of carbon efficiency with respect output. Some additional metric listed in this bucket add more screening. Those include the apportionated future emission by reserve type, the exposure to fossil fuel and core activities, exposure to carbon-related assets. After looking at our company screening methodology, we now learn about net zero portfolio alignment framework. Our model features carbon budget constraint to create climate-related financial impacts. We decarbonize the benchmark index to satisfy an overall carbon budget constraint that is consistent with 1.5 degrees of Celsius scenario. The tracking arrow depends on investor expectation on changing in the carbon emissions regulatory environment and corporate actions, reflecting companies' specification deviations from the sub-industry norm. Next, we can see is CEU's past 5 years estimate performance. From here, we can see that the estimate average return is around 8% annually. And next, I will let Francis to introduce in detail of how our portfolio is being designed and picked.
Thank you, Stella. Now let's look at one of the assets we decided to include in our portfolio. RBC issued this green bond that we can invest in that will reduce our carbon footprint. One example that they gave was investing in wind farms in the UK. They were able to produce electricity from these wind farms and thus reducing over 915,000 tons of CO2. Let's look at our proposed portfolio. First, we will look at the returns and the risk profile. We have allocated 35% to global equities, 20% to Canadian equities, 43% to bonds, and just 2% to fixed income. Using the 10-year return given by these funds, we expect to have a return of about 9.6%. As almost half will be in low-risk bonds and given the 10-year time horizon, we expect this portfolio to be of low risk. Do you recall this from before? This gave us an idea of how to estimate Scope 3 emissions that you will see in the next slide. The aim of the portfolio is to reach net zero by 2032. In order to achieve this, we looked at the funds with the lowest carbon intensity based on MSCI's metrics. We looked at clean energy ETFs, but we noticed that the carbon intensity for those funds were in the hundreds. If you look at the first ETF on our list, we see a carbon intensity of about 22 tons. Investing 5% of our portfolio will equate to $50 million, meaning 50 times the 22 tons. This would give us 1,100 tons of CO2. Now, going back to the slide we showed before, we estimated that Scope 3 emissions would be 5.7 times Scopes 1 and 2. This would give us 6,400 tons of CO2. And in total, based on our estimates, we will see 7,500 tons of CO2 for this one ETF. Adding all these emissions for the first 8 ETFs that you see will give us about 88,000 tons in emissions per year. With RBC Green Bond, we will invest 13%. This would give us 94,000 tons of emissions avoided annually. We will then end up with a negative total emissions from our portfolio. Now, any adjustments to the metrics can mean a positive total. If this was to occur, we would have to utilize carbon offsets mentioned earlier to get to net zero emissions. We, as SCD Asset Management, will 1. Ensure that the portfolio is not overexposed to specific risk factors. 2. Review constraints to achieving alignment. 3. Monitor achievement of alignment objectives. And finally, 4. Adjust asset allocation and individual securities as necessary. Finally, the net zero roadmap by SCD Asset Management includes 3 phases. First, measuring the net zero emissions and setting up short, medium, and long-term goals. Secondly, reaching agreements for net zero transition by investment engagements. And finally, executing and monitoring by communicating influence and continuous strategy evolvement with emerging standards. Thank you for your time and patience today.